welcome you all to the Preparing for the 2016 NACA webinar. If you could all start by utilizing the chat or Q&A feature and introduce what organization you represent. We can test it out that way. So I'll give you a few seconds to just type into the chat or Q&A section of the webinar platform. Okay, great. I see Joni, good morning. Thanks for joining us, and Monica and Ona. And if you have any questions throughout the webinar, please feel free to utilize this feature. Just type in your question, and we can address it with Lisa as it comes up.
Yeah, we'll make sure to, she's going to be pretty focused on the presentation, so we'll make sure to watch for that and interrupt and kind of make sure the questions are answered as they come up. Great. Okay, thanks, Stephanie. Now I'd like to turn the webinar over to Lisa Wagner with Bluestem Consulting. Many of you already know Lisa or have been lucky enough to work with her in the past, but for those of you who haven't, Lisa's worked in small business and economic development for 18 years and in the CDFI industry for 14 years. She was the founding executive director of the Wind River Development Fund on the Wind River Indian Reservation in Wyoming. And what's most relevant to point out for the purposes of this webinar is that Lisa spent 5 years with the CDFI Fund as a reviewer, so she has a lot of good insight into this process. That being said, it's my pleasure to introduce Lisa Wagner. So, okay, Lisa, you can take it away.
Thanks, Heather. So it looks like a couple of people have question marks next to their names. So I just wanted to point that out. I don't know if that means someone's typed a question.
That was just to test out the question feature. It was just to introduce everyone.
Okay, great. Okay, well, welcome everybody. I hope here I'm in Buffalo, Wyoming this morning, or actually I guess it's afternoon now, and it's a beautiful day here. We finally are feeling like maybe winter is around the corner, so I guess I'm not going to complain about that. So we're going to talk about today about, whoops, sometimes I get ahead of myself, about how you can prepare for the NACA application. Before we jump in and talk about some of the specifics, I just want to get a sense for those of you who are on the call about your experience with the NACA application, particularly in the last 2 years because the application's changed, and what type of application you're planning on writing. So, Stephanie, can you run that first poll? Is that set up as a poll?
Absolutely.
So if you could just check which one of these three is applicable. Did you apply for a NACA in the last 2 years? If you did you receive an award or not receive an award, or did you not apply? So if you just click that poll real quickly, we can get a sense of what people's experience is with the most recent application. So once that's completed, Stephanie, can you put the results up so we can see it?
Yep, we have about 50% voted, so we'll wait just a few more seconds for people to cast their last votes.
Okay, so take just another second and just check one of those three boxes, and then we'll see what people's experience have been. For those of you who don't know or haven't, didn't see when the award notices came out in September, the CDFI Fund did make the announcement that the NACA NOFA, or Notice of Funding, is going to come out in January. So we actually have a few months to prepare, which is in part why we're doing the webinar now. So it looks like about half of you received an award in the last 2 years. A few applied and didn't receive, and about a third didn't apply. Okay. So in the last 2 years, the application has changed, and the CDFI fund has said that there will not be significant changes to the application in 2016. So that's good news for those of you who have written one in the last 2 years. And it means you can look at last year's application and get a good sense of what's coming up for 2016 as well. Okay, and then let's just do one more quick poll about what type of NACA you're planning to write. Are you going to do a TA application, an FA, or have you not decided yet? So if you just click that off real quick.
Okay, we'll wait just a few more seconds for you to cast your last vote.
Okay, so it looks like about a third are TA, and half of you haven't decided yet. Okay, the other thing I can tell you we know, which is that we really don't know, is that we don't know about match yet. So I spoke with Amber from the CDFI Fund, and many of you probably know her, not yesterday, but the day before, and she said they don't know yet about how the match is going to look. However, I believe that right now in the drafts that are in Congress, the match is not waived. But in the new regulations that the CDFI Fund has out, which are in effect now, and they're out for comment until the end of the week, they actually have a provision in there where they can reduce match to 50%. So, again, that we still don't know what match is going to be, but we know that it could get waived in Congress, and if it doesn't get waived, it's also possible that the fund could reduce the match requirement. And I did ask Amber about that, and she said she couldn't tell me for sure what was going to happen, but that we should keep our eyes open and something might be coming out on that. So, okay. So let me ask you real quick, too. Does everybody have a hand-raising mechanism? Or do we not have that in this webinar? Do you know, Stephanie?
We do.
They do?
Mm-hmm.
Okay. So let me just ask you by raise of hands, how many of you are going to be writing your application in-house, doing it yourself, somebody on your staff? Can you raise your hand? I don't think I can see the hand raised. Can you, Stephanie?
Okay, we have,
oh, yeah. I see that Monica raised her hand. Natalie raised her hand. Anna raised her hand.
Okay. So it looks like we have several of you who are going to be doing it in-house. So I'm going to talk about, the things I'm going to talk about really aren't the actual grant writing today, but getting prepared. And so regardless of whether you're going to be writing the grant in-house or using an outside grant writer, these are things that are still going to be relevant for you. The difference will just be information that you need to communicate with your grant writer if you're going to be using them. Okay? Okay, so what we're going to really cover today is talking about what are things that you can pull together now so you can be ready ahead of time, and specifically what are some actions that you can take to strengthen your CDFI fund minimum prudence standard ratios so you still can do some things between now and the end of December to affect those, and then a few other general tips for getting ready for the application. If you have questions throughout, please ask as we go. I think that's the best way to do it. So you can either raise your hand or you can type a question into the chat box, and we'll just answer as we go. And hopefully we'll have a little time at the end as well. Okay, so let's just jump in. So it's really important, as I mentioned, the NACA is coming out in January. For those of you, and I I know most of you, and most of you have familiarity with writing the application, whether it's in the last 2 years or previously. You know that the NACA application is a little bit of a beast. So everything you can do now is actually going to help make your application stronger. It's going to help make sure that you have all the pieces of information that you need and that they're in place. You can actually affect your financial strength by taking some action now. And it'll give you more time if you pull these things together and prepare now to write a better application. It gives you the time to double check your numbers, which is really important, and then really to be able to submit early, which is great if you can do that. The first quarter of the year is usually a really busy time for everybody, and it's also a time when there's other grants applications coming out. So everything that you can do now to help you prepare, I think, is going to put you in a much better position for being able to submit a stronger application. So let's just jump in first to checklists, okay? So top 10 things that you'll need. Now, if I was really good, I could get Jay Leno to come on and do a top 10 list for us, but this is not nearly as exciting. So for the CDFI fund application, your financial statements, obviously, right? You're going to need your last 3 years of audits. If you don't have audits, your CPA review or internal financial statements. So be sure that you pull those together and you have them in a PDF format, because that's how you have to submit them. The other thing you can be working on now are your financial projections. And one other thing I want to add on the financial statements, and I asked Amber this when I talked with her, and she couldn't give me an answer for certain, but if you look at last year's application, the application requested the most recent quarter year-to-date financials. So if we know that the application's coming out in January, we can expect that you're going to have to provide financials through December 31st, okay? So let me ask you to raise your hand. How many of you have your year-end, your fiscal year-end is December 31st? Can you raise your hand if that's your fiscal year-end? Stephanie, can you tell me how many hands are raised?
Yeah, we've got a couple hands raised. Lakota raised her hand, Natalie, and Anna.
Okay, so a few of you have December fiscal year end. So managing, I'm going to talk about some of the MPS and how you can really affect and manage those ratios. It's going to be important for everyone because everyone's going to be submitting December 31 numbers, most likely. But for those of you who have your fiscal year end, it's really important because, as you know, the fiscal year end is what goes into your audit, and that's what will be used in future year applications, not just for CD5 fund, but for all funders. Okay. So you can start working on your financial projections right now. Make sure when you do the financial projections that you're planning to meet the MPS, and you'll need to do 3 years of financial projections based on the 2015 application. Okay. Loan portfolio data, so make sure that you're able to pull that data. The application in the last 2 years has required a lot more specific data on our loan portfolios, so we have to know the number of loans, the dollar amount. We have to know by product, by delinquencies. We have to know write-offs, recoveries, and restructures for each year. So that's information, excuse me, you can't pull for this current fiscal year, but you can make sure that you have for the last 3 fiscal years. And then the other thing that you'll need to have is a list of your funding, who the funder is, the dollar amount, and that type of information that actually goes into one of the Excel workbook tabs. So you can be pulling that together and make sure that you have that. Another thing is your policies. So for those of you who've applied in the last 2 years, you know that the CDFI fund now has listed 7 elements that they want to see in your policies or procedures. If you pull up last year's application, you can go to the policy tab in the Excel workbook and you'll see those 7 items listed. You want to go through and make sure that you have all those pieces in your policy. If you don't, you have time between now and the end of the year to get those put in and get the board to approve those policies. And one other thing I just want to note about the policies piece is that those 7 items, the fund says that they want you to have them in your policies or your procedures. So if you have, for example, one of the items is perfecting collateral, if you have a specific checklist as part of your procedures that shows how you perfect collateral, you can put that in the application. That can be included as one of your attachments. And I'm sorry, so when I say MPS, I'm sorry, I should have defined that. By MPS, that stands for Minimum Prudent Standards, and I'm going to go through those in a little bit of detail in just a minute, okay? Okay. So other things, key staff resumes. You won't need resumes for all of your staff if you have a large staff, but you want to be sure to include your loan officer, your key lending people, development service people, your executive director, your finance person, those types of folks, okay? Also, update your organization chart. That's something that you'll have to submit, and that's something you can get updated now. Market information. So one of the things the fund has always said is they want qualitative and quantitative. So that means they want the statistics and they want the stories. So, you want to be pulling the most updated poverty and unemployment numbers, economic distress numbers, and also be thinking about the stories of your community, the economic stories, and the individual stories. And those are things you can be pulling now or as we head into January, okay? And on the slide there where it says TM, that stands for target market under the 3rd bullet. So you want to make sure you're showing economic distress and lack of access to capital for your target market, okay? And I know when January rolls around and the NOFA comes out, Lisa's going to be doing another webinar specifically on writing the application, tips on writing it. And so I think in that webinar, there'll be more specifics as well, talking about some of this stuff. But this is just to give you a heads up now on things you can be starting to pull together, okay? And then the 4th bullet there is impact data. So this is a new thing that's on the tab 3 of the Excel workbook, that tab that has all kinds of financial and loan data you have to input. You also have to input your impact. So you want to be thinking about, if you pull up last year's application, you'll see that the impact, they have several impacts listed in there, the fund does, things like first-time homeowners, first-time business owners, jobs retained or created. So those are impacts that you can use. You can also come up with your own. But these are things that if you haven't pulled them for your last 3 fiscal years, or you don't know what they are for this year, you need to start working on those. And then if you're a new applicant, you're going to need to have your articles of incorporation and documentation of your EIN number. Okay? So any question on that list? So I'm going to move on then. You guys, Stephanie and Heather, stop me if you see any questions.
Okay.
Okay, there we go. Okay, so now we're going to talk about the minimum prudent standards, and I'm going to get a little bit in the weeds here, but I'm also going to move pretty quickly through these. Heather, I think, sent out to you all a list of a handout that has the minimum prudent standards on them from the CDFI fund, so there's a better definition of those. But what I want to do is talk a little bit about things that you can do that can actually manage to help strengthen some of these now if you're weak in some areas. And so I want to preface this whole conversation by saying that I'm not in any way suggesting that you change numbers to numbers that aren't correct. But there are things that you can do that can affect these numbers, particularly heading into your December 31 numbers. And also, if your fiscal year ended in September, if you haven't closed your books, there are still a few things that you can do to affect the September 30 numbers as well. So let's talk a little bit about that, okay? So the CDFI fund has 9 minimum prudent standards. 6 of them are financial health, and 3 of them are portfolio health. Okay, so let's just go through each of them quickly. And the other thing I want to say is that the application, I think, has really become much more heavily weighted in the last 2 years on financial strength, particularly if you're writing an FA application. So managing your organization to make sure you meet NPS is it's always been important, but more important than ever because of the weight that's been placed on this now. And I think it's not just the CDFI fund, but it's across the board in terms of funders. So things you can do to affect your net asset ratio. So the minimum prudent standard for the net asset ratio is that it should be greater than 20%. So the calculation is that you take your total net assets and you divide it by your total assets. Okay, so basically this is sort of equivalent to looking at how much equity do you have. So the biggest thing that affects this is your debt level, because your debt level is going to be a liability, and your net assets equals your assets minus your liabilities. Okay, so looking at your debt level, if you have a high level, I think for most native CDFIs, pretty much everybody meets this net asset ratio. It's not an area of challenge or weakness in the native CDFI industry. In fact, one of the issues is that people have been hesitant to take on debt. So I think probably most of you are meeting this or exceeding this now. And exceeding it is fine. You know, a lot of groups will be in 50, 60, 70%. And that just allows you room to take on more debt lending capital in the future. Okay? So current ratio. The current ratio is really looking at your current assets and your current liabilities, and do you have enough current assets to cover your current liabilities? So it really means, can you pay off your current obligations with the current dollars and assets that you have? So the calculation is you take your current assets divided by current liabilities, and the definition of current is anything coming due within the next 12 months, okay? So that ratio they want to see is at least 125%. So in other words, your current assets are greater than your current liabilities. One of the areas where people have trouble here is that their financial folks are not adjusting their loans receivable for the current portion. So in other words, you might show that you have a loan, let's say you have a loans receivable of $500,000. Some of those loans receivables are going to come due in the next 12 months, and those should be moved into a current portion of loans receivable in your current assets. If you're not doing that and you're not meeting this ratio, that's something you want to be sure to do. And you actually want to be sure to do it no matter what, because the stronger your current assets are, the stronger financial health you'll have in terms of being able to pay off your current obligations. Okay. Another thing you can do is sometimes people will get a grant award, or they'll have, let's say if you have a USDA or you have an ANA grant. For those of you who have ANA grants, you know that it's a reimbursable grant, so you spend the money and then you draw it down, right, once you've spent it. So if you're coming up on the end of the quarter in December and you have ANA expenses and you haven't drawn down on it, be sure you either draw down on it, because that'll put the cash in your bank, or if you haven't done the drawdown, at least create an invoice, an accounts receivable for it, because that money's owed to you. And that will increase your current assets and help you meet this ratio. Okay? So those are just a couple of things you can do to help with the current ratio. Okay, I'm going to move on to the next page. So stop me or raise your hand if you have questions. A deployment ratio. So this is really, if we look at our total lending capital, how much do we have out in loans? So the calculation is our total loans receivable divided by our total lending capital. And this, again, is a balance sheet number. So on December 31st, that's the number that you'll be calculating. So on December 31st, what are your total loan receivable, and then what's your total lending capital? So the first thing you can do, you definitely want this higher than 50%, okay, because that's the minimum prudent standard. But really, one of the things the CDFI fund looks at when they're giving FA awards is how much do you really need their money. So if you have only a 50% deployment ratio, that means that you still have quite a bit of capital. So really, the sort of sweet spot for deployment ratio is more like 70 or 80%, right? Because then, 80% of your money is out to your borrowers, and so you're really needing to bring in more dollars. So the control that you have over the deployment ratio is really, one, how do you calculate your lending capital? So your lending capital, sometimes that's defined very clearly, and sometimes you'll look at your cash and what cash can you use for lending. The CDFI fund calculation is going to take all of your unrestricted cash and assume that you can use that for lending capital unless you subtract out some. And so if you have a low deployment ratio, one thing you might do is look at your unrestricted cash, and you want to set some of your unrestricted cash aside for operations, for example, right? So you want to pull out money for operations. So how you define your total lending capital, there's some flexibility in that, and look at how you define that and how that impacts your deployment ratio. Another thing to keep in mind in terms of deployment is if you're coming up on the end of the quarter, the end of the year in December, and you have some loans that are close to closing, if you can really push to get those closed, that's going to help your deployment, and that's also going to help your loan volume. So that's going to strengthen your overall application. So again, I'm not suggesting that you close a loan quickly when it's not ready to be closed, but you know how sometimes things can take a little bit longer. If you're coming up on the end of December and you have some loans that are close to being closed, if you can really push to get those closed, that's going to help increase your deployment ratio and also increase your loan volume, which will strengthen your overall application. The other thing is you should never show more than 100% deployment for the most part. I mean, there actually are a few sort of strange exceptions, but really, for practical purposes, if you're showing over 100% deployment, that means that you've lent out more money than you have, which isn't really possible. So just check that number when you're doing the calculation and make sure that that's not over 100%, okay? Okay, self-sufficiency. So this is probably the minimum prudent standard that people have the biggest challenge with. Particularly the native CDFIs, because so many of us are operating in rural markets and we're providing so much technical assistance that a lot of that has to be subsidized. So self-sufficiency ratio is looking at the total earned revenue over your total expenses. And earned revenue includes your interest income from your loans. It includes fee income from your loans. It would include any fees that you charge for training, and it also includes contract revenue. Okay, so this is an area where sometimes people can help boost their earned revenue. If you have a contract for service, let's say, for example, you're providing financial literacy training, and you're doing that, you have a contract with the TANF office, and they're paying you to do financial literacy training. Make sure that you book that as a contract on your profit and loss statement and not as grant income, because contract income goes towards earned revenue and grant income does not. Okay, so that's one area where I see people make a mistake in terms of calculating earned revenue. Another thing is, if you look at the denominator in that formula, that's your total expenses for your whole organization. That includes depreciation, and it includes loan loss reserve expense, and all other expenses that you have on your profit and loss statement. So if you're if you're coming close to your self-sufficiency ratio, you're not meeting it. If you have a big purchase, for example, that you need to make, you can delay that until next year. And the next year, you can look at other strategies to grow your earned revenue. But that will improve your self-sufficiency ratio this year, right, if you push off a large expense till next year. Another big factor that affects self-sufficiency ratio and hits the total expenses is your loan loss reserve adjustment. And so right now in the CDFI industry, there are a lot of CDFIs who are over adjusting for loan loss reserve. In other words, their loan loss reserve, they're keeping too high of a loan loss reserve. So you want to look at your loan loss reserve, and we're going to talk about that in a minute also because it's another MPS. But look at your loan loss reserve and make sure that it's appropriate. And talking about the specifics of loan loss reserve is a whole webinar or day training in and of itself. So I won't get into the details here, but if you're not sure if your loan loss reserve is close or accurate, take a look at it, talk with your finance folks, and I'd be happy to take a quick look at it for you as well. But basically, you want to look at, make sure that that's appropriate. And again, we're going to hit that again in just a minute. Okay. So the fifth MPS is operating liquidity. So really this is just about making sure you have enough cash in the bank to cover 3 months worth of your total expenses. Okay. So the calculation is taking your total unrestricted cash, and this is going to be on your balance sheet at year end, and then again at December 31. The total unrestricted cash that you have, and that's a number that you enter in your Excel workbook, and then it will divide that by 1/4 of your total annual expenses, which is basically 3 months. Okay, so you want to make sure you have enough unrestricted cash to cover 3 months of operating expenses. So what do you do if you don't have enough? If you're heading into the end of December and it's looking like you're going to be short on cash. So maybe, for example, if you have A&A, you know that's coming up, get that reimbursement request in so you can get the cash deposit in your bank account by the end of the quarter, okay? The other thing is so when you have a grant that's released from restriction, that's going to make that unrestricted, right? So if you have, let's say you have a NACA grant, a TA grant, or an FA grant from last year, you can go into your books and make sure that you're tagging all eligible expenses to those grants because that will release those dollars from restriction and increase your unrestricted cash, okay? Again, the loan loss reserve adjustment, so because the total expenses is in your denominator here, if you're over adjusting for loan loss reserve, that's going to increase your expenses and decrease your liquidity. So you want to look at that. And then again, the same comment as before for decreasing expenses is defer big purchases till next year if you can. Okay. And the other thing I wanted to say, for those of you who had fiscal year ends on September 30th, the loan loss reserve is one you can go back and look at and still make an adjustment on September 30th if you haven't closed out your books and your auditors aren't already in there. So that's something you can actually go back and make an adjustment on. And the same thing with grants, tagging grants. So if there are some, if you have an FA grant or TA grant, and there were some expenses that you had last fiscal year, if your last fiscal year hasn't closed out yet, you can go back and still make some of those adjustments, okay? Okay, net income. So net income is pretty easy. You just want to have enough revenue to cover your expenses. And again, the same things that we talked about in terms of hitting your expenses, making sure you're tagging eligible expenses to restricted grants, not over adjusting your loan loss reserve and deferring purchases will help you have positive net income. Okay, So let's go on to number 7. So now we're getting in the last 3 are portfolio management standards. Okay. So number 7 is the portfolio at risk. This is really your delinquencies. How delinquent are your loans? This calculation, the MPS, is based on 90-plus days delinquent. Okay. And I put up here the delinquency ratios for the different types of loan product that you have. One thing I can tell you is that when you fill out your Excel spreadsheet, you're going to designate what is your primary type of lending. So if you're doing loans, if you're doing business loans that are $50,000 or less, even if you call them a business loan, in most definitions, that's a microenterprise loan. So make sure you put microenterprise loan as your primary type of business, because that will affect your PAR automatic calculation on the spreadsheet. So again, one thing you can do, you're coming up on your year-end, your quarter-end, really make a hard push to get delinquent loans current. I mean, we should be doing that all the time, right? But sometimes we fall behind on it, or we're not, we haven't sent out that notice, or we haven't made the call. So do whatever you can to get those loans current. And the other thing I really recommend is if you have a loan that needs to be written off, it's 90-plus days, it's been 90-plus days for a long time, they're not going to pay, write it off. Because if you don't, you're going to get a double whammy, right? Your year-end, this is particularly coming up on your year-end for those of you whose fiscal year-end is December 31. If you're not writing off a loan that's 90-plus days delinquent, and it really is not going to get paid back, you're going to get hit with a 90-plus day delinquency this year, and then next year you're either going to have to write it off, or it's going to be 90-plus days and you're going to get hit with it again next year. So if you write it off this year, next year you're going to start with a clean slate on that loan. And either way, you're getting hit with it this year. So really look at what loans do you need to write off. The annual loan loss ratio is really your losses. So your write-offs. What percentage of your portfolio did you have to write off? So again, one thing you want to do here is only write off your loan down to the value of the collateral. So let's say you have a $10,000 loan and it's not going to get paid, but you have a truck that you know is worth about $4,000. You'll write off $6,000 of that loan. You're going to get the truck and sell it, and then use that $4,000 to pay down the remainder of the loan. Okay, so don't write off more. Only write off to the amount that you think you aren't going to be able to collect. Okay, and that will help keep your losses down. Okay, so we got one more. A loan loss reserve, and again, I know this is sort of a complicated issue and topic, loan loss reserves, but this is also one where a lot of folks I've seen, particularly in the last couple of years coming out of the recession, are keeping too much in loan loss reserves. And the thing you need to know when you do that impacts your balance sheet. It makes your net assets less, your total assets less, and it impacts, you can see all of the MPS ratios that it impacts that we've gone through today, okay? So make sure that you're accruing an appropriate amount. Look at your actual losses and your actual delinquencies, and that will give you an indication. And then if you don't have an accrued loan loss reserve on your balance sheet, you need to add one. You need to put one on, okay? And talk with somebody about how to do that if you're not sure. I have a number of sample PA memos and things like that I can send you to help you better understand the loan loss reserve accrual. But this is an MPS that a lot of groups are missing. And so now in the application, the new application, if you don't meet an MPS, you automatically lose points. So you want to try to meet MPSs, as much as reasonable. Now, one thing to keep in mind is that This also includes cash, and so cash and accrued reserves are different. But let's say you have a funder like SBA or USDA that requires you keep a cash reserve. That may cause you to miss the NPS, and that's something you can explain in your narrative. Okay. Okay, so I know I went through these pretty quickly, but I just wanted to give you some kind of tips and ideas about ways you can manage some of these coming up on the quarter end. Particularly the December 31, which is going to be numbers we're pretty sure are going to go into the 2016 NACA application. And some of these tools will help you strengthen your financials and your NPS and your overall application. So any questions about these NPS? Okay.
We're not seeing.
Okay, so just a couple of final tips for you. If you have an existing CDFI fund award, make sure you're current on all your reports. Go into what used to be My CDFI Fund and is now AMIS. And one, make sure that you've gone in there and created or updated your information if you haven't already. I think you have to change your password, and so do that ahead of time. Also, make sure you're current on those reports. So even if you've been late on a report, get it in. And then make sure you're registered and current on SAMS and on grants.gov. I can't tell you how many groups I've worked with who had issues with one or two, either SAMS or grants.gov, and it prevented them from being able to submit their application. So really important to make sure you go in, and now's a great time to do that and not feel overly stressed about it. You can have it all ready to go when the application comes out. Okay, so I think that's it. Those are sort of the key tips and pieces that I had. Are there any questions or comments that anybody has? Does anybody have any other tips or things that they're doing to prepare?
Yeah, and if you want to ask a question of Lisa or comment or share anything, just raise your hand and we'll unmute you too. Or if you have a question, just feel free again to type into the question box. Either would.
Okay, well, I guess if there's no questions, I'll just turn it back over to you, Heather.
Okay, thanks, Lisa. Thanks for that presentation, and thank you, everyone, for participating in the webinar. I hope that we provided information that will be useful to you as you prepare for the NACA application in January. I wanted to make sure and let everyone know that this year OESTA is going to be contracting with organizations to either write NACA applications or review NACA applications. We sent out an announcement about this, but if you want more information, just shoot me an email at heather@oesta.org. Also, a very brief survey should pop up when you close this webinar, and just please fill it out. It helps us track this webinar series and make sure that we're always continuing to improve. And finally, next month's webinar is going to take place November 18th at noon Mountain Time, and we're going to be discussing beyond the census, finding data to support grant proposals, and we're going to be sending out more information very soon on that. So yeah, have a wonderful rest of your day, and again, thanks for participating.